Okay, so what we're going to do now is discuss the preparation of the statement of cash flows using the indirect method. The information we're going to be the information we need to prepare the statement of cash flows is going to be the income statement, comparative balance sheets, and some additional miscellaneous information that's going to be associated with investing and financing activities. Here's the income statement. This is for Sports Time Incorporated. For the year ended December 31st, 2017, their net income was $937,300. Comparative balance sheets means that we want, since we're looking at preparing a statement of cash flows for the period ending December 31st, 2017, then we're going to need the balance sheet as of December 31st, 2017, which is in this column here. But we're also going to include the balances as of 16, which makes this a comparative balance sheet. 2017 and 16, we're comparing the two periods. This 2016 is what it was at the end of that year, and 2017 is what it was at the end of this year. Now, when we say comparative as well, we're going to go through each line item and we're going to compute what the differences are, whether they've increased or decreased. If they've increased, there will be a positive number. If it's decreased, we'll show the decrease, but we're going to show it in brackets as a reduction. So as an example, cash went up by $78,500. Accounts receivable went up by $35,000, but inventory actually decreased or went down by $25,000. We're going to note that here. We're going to do that for every account, and we're going to be using that information for the statement of cash flows. Preparing the statement of cash flows for operating activities. So the first section, as we've talked about, is the operating activities. And the way we're going to do this is first we're going to start off with the accrual-based net income using the, by the way, this is the indirect method. We're going to begin with using the accrual basis net income. We're going to make adjustments to that net income to convert it back to cash basis. And these adjustments are going to include non-cash expenses and revenues. We'll go through that. Changes in current assets and changes in current liabilities. For that reason, we did all those additions and subtractions over on the balance sheet because of these two requirements. So the first section, first we're going to take the net income, $937,300. Let's go confirm that. We're going to go back to the income statement. Net income, $937,300. The first thing we're going to do is adjust for non-cash expenses. These are expenses that are on the income statement that really have little to do with cash. Little to do with cash. The first thing we're going to look for is depreciation expense. Well, let's go to the income statement and look for depreciation expense. Nothing here, nothing through here. There's depreciation expense. What was it? $142,000. Now, if you recall, the depreciation expense recording is a debit to depreciation expense and a credit to accumulated depreciation. That has nothing to do with cash. So we recorded this entry before to come up with the income statement, but that was an expense that reduced income. It reduced income because it was an expense. So if we're trying to get to this number to be more like cash, then we're going to add that back. We're going to add that back to this net income. So depreciation expense is going to be a positive number. We're going to add this back. The next section, we're going to look at non-cash revenues. We could have a revenue, well, not necessarily the sales, but we could have a gain or the sale of equipment. If it's a gain on the sale of equipment, then that is other revenues. And again, if you recall how that's recorded, the gain is basically recorded, not basically, the gain is recorded by taking the difference between the consideration, what was received, and the book value of the asset. Well, that has little to do with cash. So we had a gain on the sale of equipment of $1,000. Since it was a gain, let's go back to the income statement. It was a gain. It added to income we're going to have to subtract that because that number includes the addition of that had nothing to do with cash. So a gain on the sale of equipment is going to be a reduction of statement of cash flows. The next we're going to do is look at changes that occurred in current assets. Current assets, do they go up or down? If a current asset goes up, then the result will be a decrease or subtraction of from net income on the statement of cash flows. So it's an inverse relationship. If a current asset goes up, the impact on the statement of cash flow is a reduction or subtraction. If a current asset goes down, then it's going to be an increase to the statement of cash flows. So there's an inverse relationship. If one goes up, the other goes down. If one goes down, the other one goes up. If we can remember that for current assets, then it should be pretty easy to go. Should be pretty easy for us to figure out. So accounts receivable was $330,000 in 16, ended up being $365,000 in 17. That was an increase of $35,000. Since it was an increase of $35,000, that's going to result in a negative or reduction on the statement of cash flows. So we have the depreciation expense. That was in adding back depreciation expense. The gain on the sale, we reduced that. Now, the increase in accounts receivable is a reduction, okay? If we go back, we'll see that there was a decrease in inventory. That decrease in inventory results in an increase to the statement of cash flows. There was an increase in prepaid insurance. That's a decrease to the statement of cash flows. So these three here are examples of the inverse relationship between the current assets and the statement of cash flows. If one has gone up, then they go down on the statement of cash flows. If they've gone down, they go up on the statement of cash flows. For current liabilities, they go in the same direction. For current liabilities, they go in the same direction. If a current liability goes down, then the impact on the statement of cash flows would be a subtraction or reduction. If a current liability goes up, then the impact to the statement of cash flows will be an addition. So we're looking at interest payable, accounts payable, other accrued expenses payable. Those are all current liability accounts. Income taxes payable, wages payable. Let's just go look at the first one and then we can conclude what happens to the others. Accounts payable was $285,000, ended up at $245,000. That was a decrease. They go in the same direction. That's going to have a negative impact to the statement of cash flows. Let's go confirm that. A decrease in accounts payable is a reduction or subtraction on the statement of cash flows. An increase in wages payable is an increase or addition to the statement of cash flows. A decrease in interest payable, decrease to the statement of cash flows, increase in income tax payable, increase to the statement of cash flows, a decrease in other accrued expenses payable, a decrease to the statement of cash flows. We're going to sum all of these up. That's a positive. We're going to negative, negative, positive. We're going to sum these up. And the total reconciliation adjustments, $103,200. So we started off with net income of $937,300. We're going to add back the reconciliation adjustments of $103,200. And the result is net cash provided by operating activities of $1,040,500. Now, the reason this says provided by is because the result is positive. If incidentally this number is an actual negative number, which can happen, then this would be worded net cash used by operating activities. Provided by is for positive, used is negative. In this case, it's positive, so it's provided by. Okay, so that's the operating activities using the indirect method. Now we're going to go over to investing activities. Not only are we going to look at the comparative balance sheet, and we're going to look specifically for property, plant, and equipment, accumulated depreciation, and investments. But we're also going to use this formula to help us understand the changes to find the cash sources and uses. Beginning long-term assets plus purchases of assets minus assets sold will equal the ending balance. Okay, so the additional information we're going to need to make this work is for the investing activity section. Equipment originally costed $25,000, was sold for $3,000. The equipment had an accumulated depreciation of $23,000, resulting in a gain of $1,000. Now we know about this gain. We already used that. We know about this $1,000 gain. We used that or took it into consideration when we were looking at the statement of cash flows for operating activities. But what we didn't know was how it came about. And so it looks like the book value of 25 less the 23 was 2,000. We sold it for 3, so that we ended up with a gain of 1,000. Now, what's relevant here is the 25,000. The 25,000 is what's really relevant for us. Because if you recall in the previous section, it says we want to come up with the beginning long-term assets plus purchases minus the assets sold will give us the ending balance. Well, if you think about it, we know what the beginning long-term assets balance was. We just look at the comparative balance sheet. What we don't know is the purchases. We were given or told what the assets sold were, and we know what the ending balance is. So we're going to come up with the formula here. The formula is going to be the beginning long-term assets plus purchases minus assets give us the ending equal. This is what we just went over. This is that's this formula here, except I put it on a spreadsheet here. So all we have to do is figure out, well, what are we trying to solve for? We're trying to solve for the missing variable, that is purchases of assets. Beginning long-term assets, $2,900,000. Let's go confirm that. $2,900,000. We take it from 2016. That was the ending balance for 16, so that becomes the beginning balance for 17. 2,900,000. Purchases assets, we still don't know what that is, but what we were given through the narratives, equipment originally costing $25,000 was sold. So the $25,000 is what we need. So let's go back to our formula. We don't know what purchases of assets are. That's the X, that's the unknown variable. But we were told we take our beginning and we add purchases, which we do not know, and we subtract the assets sold. Well, we know what that is. That's 25,000 that was given to us here, right? That should equal our ending balance. Well, we also know what that is. How do we get that? That's what's listed on the comparative balance sheet. $3,415,000. That was given, that's on the comparative balance sheet. So we're trying to look at or find what the assets purchases for cash. What was that? Well, that's the X. And now we're going to solve for the unknown variables. So we put this formula together. $2,900,000, that's this number, plus X, which is this one, minus $25,000 equals $3,415,000. Using our pre-algebra skills, we should be able to solve for X. First thing we're going to do is we're going to add 25,000 to both sides of the equation. When we do that, this is going to disappear. Negative 25,000 plus 25,000 is going to give us 0, so this will disappear. We're going to add 25,000 to the right side of the equation, and that's going to give us 3,440,000. So after we make that adjustment, the 25,000 added to both sides of the equation, our formula is now going to read 2,900,000 plus X equals $3,440,000. And now we're going to isolate the X. To isolate the X, we're going to subtract $2,900,000 from both sides of the equation. When we subtract it from this side of the equation, we just end up with X. When we subtract it from the right side of the equation, we end up with $540,000. So that is X. That is purchases of assets, and that's what we're looking for. Now, it's a purchase of assets, so that means that's cash used to purchase property, plant, and equipment. Used cash is a reduction of cash. That's negative $540,000. Now, we're also going to take into consideration the $3,000 that we received, the $3,000 that we received for the sale of that same equipment. So the proceeds from the sale of the equipment, $3,000. And then finally, the last bullet point says the company purchased $100,000 of stock in XYZ company. Well, that was the case. That's used, we purchased, that's money going somewhere else. So cash used to purchase investments in stock, negative $300,000. So we're going to sum this up. That's a negative $540,000. We're going to add $3,000, but then we're going to subtract $100,000. And that means that the sum of this is equal to negative $637,000. That's net cash used by investing activities. Negative $637,000. The last section is the financing activities. We're going to be looking for changes in the long-term liabilities, common stock, and retained earnings. Here are formulas that we can use if we need to. I think what's going to actually be given is going to be sufficient for us in the example here. So additional information is 100,000 of new bonds were issued during the year. 300,000 of bonds were repaid during the year, and the board of directors declared cash dividends of $125,000. So 100,000 of new bonds were issued during the year. When they're issued, that's cash coming in. We sell bonds, money comes in. So this is a positive. Positive proceeds from the bond issuance, positive $100,000. 300,000 of bonds were repaid. The key word is paid during the year. Paid means money going out. That's cash outflow. $300,000 paid. And then cash payments to dividends. The board of directors declared cash dividends of $125,000. This should read declared and paid cash dividends. We're going to assume that, but it should read paid. Declared and paid cash dividends, $125,000. That's a negative $125,000. We're going to sum the $100,000 positive, the negative $300,000, and the negative $125,000. We're going to sum this up, and that ends up with a net cash used by financing activities of a negative $325,000. Now that we have the operating activities, investing activities, and the financing activity amounts, $1,040,500 for operating activities, that is a positive. Net cash used by investing activities, that's a negative $637,000. And net cash used by financing activities, that's a negative $325,000. We're going to sum those three up, and we will get a net increase in cash, a positive $78,500. We're going to go to the balance sheet and look what was the beginning cash for the year, which will be equal to the ending cash of last year. Cash, what did we start off with in 17? Well, what did we end up in 16? $125,000. That is our beginning balance for 17. Cash beginning for the year, $125,000. So $78,500 plus $125,000 gives us the cash at the end of the year, $203,500. This must equal what's being reported on the balance sheet at the end of the year, the cash balance, $203,500. Let's go confirm. Cash 2017, $203,500, $203,500. That's what's reported at the bottom of the statement of cash flows. There is such thing as free cash flow. The free cash flow is computed by taking the amount of excess cash a business generates after considering necessary capital expenditures. So we're going to take sports time free cash flow is computed by taking $1,040,500. This came from the statement of cash flows, net cash provided by operating activities. We're going to subtract from that the cash that was used for capital expenditures, cash used to purchase property, plant, and equipment, $540,000. $1,040,500 minus the $540,000 gives us $500,500 of free cash flow. Free cash flow. That's how that is computed. There's 5 steps listed there. You can review those.